Let us now discuss what are stocks. Stocks represent ownership in the company. Suppose I have four people, and then this person invested 1 million. And then here, she also invested 1 million, 1 million, 1 million. So meaning to say the company has 4 million, right? 4 million. So that means this guy represent 1/4. They each own 1/4 of the company. All right. What about in this example here? This woman owns 20 million, invested 20 million in the company. This man invested 10 million, 10 million, and 30 million. If that is the case, this means that A owns, this is person A. A owns 2/7 of the company. Where did we get that? That's 20 million out of 70 million, right? And B and C owns 1/7 of the company. D owns 3/7 of the company. So to understand more about stocks, let us watch the following video.
Learning about investing is a lot like learning to ride a bike. At first, it may look intimidating or complicated. Dangers seem to be everywhere. That's why it's important to learn the basics and ways you can help minimize risk and protect yourself. After a good amount of practice and learning, you can take the training wheels off and really start riding. Along the way, the roads may change. There'll be good days and bad days. And while learning to ride doesn't guarantee you a spot in the Tour de France, riding a bike could get you where you want to go a little faster. Let's start with the basics and look at one of the most common investments, stocks. A stock represents partial ownership of a company. When you purchase a stock, you're buying a piece or a share of a company. By owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. There are two ways you can make money by investing in stock. The first is through stock appreciation, when a stock you own goes up in value. If an investor bought the stock at one price and the price went up, the investor could then make money by selling the stock to another investor at the higher price. The second way is through a dividend. This is a periodic payment issued by some stocks. A dividend is a way for a company to give a portion of its earnings to shareholders. Here's an example of how stocks work. Suppose there's a company called Bull Flag Cycling. This company makes bikes, really good bikes. The bikes are so good, in fact, the company wants to expand, so it can sell more bikes to people all around the world. To do this, the company needs to raise money, also known as capital. There are a few ways this company could do this. It could take out a loan, but that would mean taking on a significant amount of debt. Or it could issue shares of stock. By issuing stock, which is called going public, the company can raise money without going into debt. Instead, it sells shares of ownership and a claim on future earnings to investors. So let's meet a typical investor. Our investor is someone who has a little extra cash. He's looking for an investment that has the potential to offer better returns than a savings account, and he is willing to accept the higher risks of investing in a stock. He thinks Bull Flag Cycling is a promising company that's likely to grow. Because of this, he thinks buying a share would be a good investment. So how much does a share cost? Suppose the company decides to raise $1 million, and it decides to issue 1,000 shares of stock. Because each share represents a fraction of the company's worth, and there are 1,000 shares, each share represents 1/1000th of Bull Flag Cycling. Because the company is raising $1 million at the initial public offering, or IPO, each share would be initially valued at $1,000. Let's suppose the price doesn't change after the IPO, so our investor purchases a single share on the open market through his online stockbroker for $1,000. Now, let's see what could happen to his investment. If the company does well and profits increase, the value of the company is likely to go up. As a result, the stock price may increase as well. Assuming the price of the stock goes up, our investor could now turn a profit by selling his shares to another investor in the stock market. However, if the company's ventures don't go as planned, its value could decrease, and so could the stock price. If this happens, our investor could lose money if he decides to sell at the current price. When it comes to investing in the stock market, the basic goal is to buy when prices are low and sell when prices are high. But stocks in the stock market don't always go up. Sometimes they stay the same, and sometimes they go down. And sometimes prices change quickly. Because of this, stocks are considered riskier than other historically safer investments such as bonds or CDs. However, investors keep coming back to the stock market. Why? Because with this increased risk comes the potential for greater returns. Savvy investors take precautions to try to minimize risk, like creating an investing plan, adding diversity to their portfolios by investing in a variety of companies, putting money in other investments besides stocks, and learning trading strategies for up, down, and sideways markets. Now you know some of the basics about investing in stocks, but that's just the beginning. Open an account with TD Ameritrade for access to more award-winning investing education.
Okay, I have here a company stock certificate. So usually stockholders receive a certificate which contains details like the corporate name, in this case, corporate name, the owner's name, you put it here, the number of shares, where is it? Anyway, certificate number and the par value or the face value. We will discuss all of those terms in detail. It was mentioned in the previous video that you can earn money in stocks through two ways, right? The appreciation of the share price and through dividends. So to explain dividends, this is a detailed infographic for that. So first, you have to invest in the company. Investor purchases one or more shares in a dividend-paying company. And then the company evaluates performance at the end of each quarter. And then if they have enough money, they may or may not announce a dividend payment. And then after the company announces that, the investor is paid the stated dividend. And take note that the dividend also depends on the number of shares that the investor owns. Of course, those who invested more will get higher dividends. All right, so it's like one share. One share will get, let's say, 10 pesos. Okay, so it's also um, written. Okay. We have two different kinds of stocks. First one is common stocks. The second is preferred stocks. Let's see the difference. First, for common stocks, they have voting rights. One vote per share owned. The second is that they get variable dividends that are declared by the board of directors, and they are the ones who are last in line when it comes to company assets. So meaning to say, if the company gets bankrupt, all right, and then they will be the last in line when it comes to company assets. Preferred stocks have no voting rights, although they also share part of the company, but they don't have voting rights as compared with common stocks. And they are guaranteed a fixed dividend in perpetuity. Meaning to say they always, what are dividends again? They are just money that is being given to the investors, and they get that regularly, and it is fixed, and they have priority over a company's income. Whereas if you compare that with common stocks, okay, yeah, they always get the income. It's not that they always get the income, they just have a priority. Now let's look at the different terms when it comes to stock. What do we mean by par value? It is a per share amount appearing on stock certificates. So for example, par value is one share cost 10 pesos. That is the par value of your stock. Earnings per share, of course, the amount of profit to which each share is entitled. So for example, the company has declared that they have a profit this year. So, okay, one share will get 2 pesos profit. Again, so remember for stocks, everything will depend on the number of shares that you own. What is IPO? It is an acronym for Initial Public Offering. This is the first time where the company sells stock. Okay, so it was shown in the previous video about stocks, right? Wherein if the company wants to, let's say, expand and they don't want to loan money from the bank, so they will now go through IPO. They will sell shares so that the investors will give them money, right? And in return, when they realize a profit, they will give dividends to their investors. Going public, it is just a slang for when a company is planning an IPO. And lastly, underwriter is the financial institution or investment bank that is doing all the paperwork and orchestrating a company's IPO. Okay, we have mentioned earlier in the videos that there are two ways to earn money through dividends, and the second one is when there is an increase in share price. Okay, now let's look at this term. What is dividend yield? That's the annual dividend per share over current stock price per share. Alright, so suppose you own 500 shares of a certain company which pays 11 pesos per share in annual dividends. If the current stock price is 120, find the dividend yield of the company's stock. Okay, here is the formula again for the dividend yield. Annual dividend share. So in our case, what is the dividend per share? That is 11 pesos, right? Over current stock price per share. And what is the price of one share? It's 120 pesos. Of course, we want to convert our answer in percent form. So we multiply it by 100%. So when you use your calculator, you will get 9.2%. That is your dividend yield. Next, what do we mean by the return on investment? So just like the dividend yield, you're actually getting what percent of my investment did I earn? Okay, that's the meaning of return on investment. It's actually a rate, all right? Because as you can see here, it's multiplied by 100%. All right. Example, suppose you own shares of a company which just paid you 20 pesos per share in annual dividends, just like in our previous example. If the original price per share is 1,000 and the current price per share is 1,020, find the total stock return on investment. Let us solve this problem. So again, I have here the formula. So first, we have to get the net return on investment. Okay. So first, here, how much did you get all in all? So since there is an increase in price from 1,000 to 1,020 per share, right? So that means you gain 20 pesos, right? 20 pesos. But you also get dividend, which is 20 pesos per share. So this 20 pesos, the first 20 pesos, you got that from the Prince. You got that from price increase of stock. And then the second one, you get dividend, right? Per share, you get a dividend of 20 pesos. Okay, take note that for here, the ROI, you get the net return on investment. It's always per share. You're just looking at the net return on investment per share and then the cost of investment per share. So anyway, what I'm saying is that for the numerator, you have your net return on investment is 20 plus 20 over what's the cost of investment originally, right? Original is 1,000 because this is how much you bought your share, right? So this is 40 over 1,000, but of course times 100%. So you get 40 over 10 or 4%. So that is your ROI. Alright, stocks are publicly bought and sold in stock markets, the main role of which is to facilitate the process of buying and selling of stocks. There are two types of stock markets, primary and secondary. So primary stock market is when a company issues its shares for the first time. Take note of that. For the first time via an IPO. Whereas the common stock market that we know, that's the secondary stock market, wherein the previously issued stocks are traded without the involvement of the companies which issued them. Let's look at some terms when you look at a typical stocks table. So for the first column, you have your 52-week high. What does this mean? It gives you the highest price that particular stock has reached in the most recent 52-week period, or meaning to say in the 1 week, I mean not 1 week, 1 year period. And the 52-week low, of course, gives you the lowest price that particular stock reached in a period of 1 year. All right. And then of course you have your name symbol. You always have the name of the company and then followed by the symbol. This one is the dividend column. Take note here that not all stocks give dividends. So for example, in this table, the LDI and VNIs are only the ones that give dividends. Next, we have volume. So this tells you how many shares of that particular stock were traded that day. So for example, this is saying that 3,143 shares were traded that day for Sky High Corporation. Okay. Our next column is the yield column. This is actually the yield that we talked about, right? It's calculated by dividing the annual dividend by the current price. So as you can see, we don't have yield for Sky High Corporation because they did not give dividends. Only the companies which issued dividends get the yield entries in the yield column. All right. And of course, we have the P over E. P stands for price of the stock and E stands for the company's earnings. So, what if you're an investor, what will you look at? Do you want a bigger PE or a smaller PE? So of course, you want to get a smaller PE, price per earning. For example, what is the meaning of this 76? This means that in order for you to get $1 earning, the price of the stock is $76. Whereas for 12, which is like in VNI, just like here in VNI, that's 12. So you get $1 earning for a cost of $12. That's just an illustration because again, this is just a ratio. All right. The day last, it tells you how the trading ended for a particular stock on the day as represented by the table. So what does this mean? It means that if we look at SHC, it ended at one share is 21.25. All right. And the net change is, it answers the question, how did the stock price end today compare with its trading price at the end of the prior trading day? So for example, a plus 0.25 here means that yesterday, the price, the day last of SHC was 21. This negative zero point 0.5 here for LDI, it means that yesterday the day last column was 41.5. Is that clear? Here are the golden rules when it comes to investing in stocks. Number one is that you have to invest early. Diba there's a saying that time is gold? It actually is. Time is really gold. So if you want to start investing, don't wait for tomorrow. The earlier that you start, the better. All right, we will discuss more of this. Then the second one is that you have to invest regularly and of course invest long term, and lastly invest using diversification, or meaning to say don't put all of your eggs in a single basket. All right, so let us look at this table over here. So suppose you just have 25,000 and then you are investing for your retirement and you have 25,000 pesos and then you invested that when your age is 25. And then you plan to get your money, of course, in your retirement age, which is 65. And then here in this column, you will invest your 25,000 at age 35, 45, 55, and so on. Again, for all of them, the amount invested is just 25,000 pesos. Just one-time payment. Let's see how much your money will grow. So that's equals P times 1 plus your rate, which is 0.08, but then this time raised to, right? This is assuming it is compounded annually. Of course, the assumption here is that you are investing it in the stock market. Oops, what happened here? This one should have times. Oh, I know that's text. Should be general. Will it work again? Equals, maybe just number. Equals 25,000 times P times 1 plus R raised to 40. There. Wait, it's better if I make it accounting. There you go. Let me just do my, so that I have the same column. Alright, and then when we do that, oops, this is I should get a dollar sign here so that it will always, even if I drag it, it will always be at 25,000. Now, I am ready to drag. Okay, so as you can see, right? So if you started late, 10 years after, you will lose more than 250,000, right? Because really, time is gold. So the earlier that you invest, the better. Okay, so aside from investing early, you also have to invest regularly. So suppose in this case, I have here cases wherein at age 25, you started investing 25,000 per year. Okay. And unlike our previous example, wherein it is not a one-time payment. In our previous example, you just invested 25,000 and that's it. And then you waited for 45 years. But in this case, what we will do is you keep on investing 25,000 every year. Okay? So, for example, by year 26, okay, what will happen? First, your 25,000 will will gain interest, right? Okay, it will gain interest. So what is the formula? What is now the accumulated value? It's 25,000 plus 1 plus, oops, okay, 1 plus 0.08, right? And then plus, you now will add additional 25,000. Okay? So by age 26, you will invest 52,000 because the 25,000, what happened there? The 25,000 plus its interest, and then you added another 25,000. Is that clear? I'm assuming here 8% per annum because this is stocks. So I will just one drag down. Okay, what happened here? So again, it's the same. Your 52,000 here, whatever is your previous balance, it will earn interest, right? So that's why you have this. And then you add another 25,000. Okay? So let's see what will happen when we drag that by age 65. So by age 65, you now have your accumulated value is now 7 million, right? That is really the power of compound interest. Now, for this 7 million, that is your accumulated value. But what is your total investment? Meaning to say, how much did you spend to get that 7 million? It's 25,000 times you invested that for 40 years, right? From age 25 to age 65. Oops, what happened? This one should be, again, general. Uh, okay, that's already general. 25,000 times 40. So there, as you can see, you only invested 1 million, but see your investment was multiplied 7 times. Okay, let's do that also. What if you started investing already at 25,000? So you started here and then again, I will just copy the formula. Oh, wait. This is equal to 25 times just the same thing. You have 1.08 plus this one. So see, it's just the same. Then this one up to 65. And then I will do that also if you started already at 45. Lastly, when you started already at age 55, you waited for your kids to grow up. Okay, let's now look at this one and then your total investment, although I will change this. This one, you just invested for 30 years. This one, you invested for 20. And this one, you invested only for 10 years. Okay, so let us compute the return on investment, ROI. You still remember how to get the return on investment? It's equal to the return. What is the return? The difference, right? Minus this one. Over how much did it cost you? Correct? Oops, again, it's in text. Again. Wait, general. Okay, this is equal to the difference, your profit minus 1,000 over how much did you buy it. Okay, so see your ROI is actually, this is times 100, right? Para maging percent. Anyway, we can just put this to percentage. See? And then I will just drag this. See? You get the best from your investment. Of course, you will expect the amount here to be smaller than the one when you invested at age 25 because you invested here only 250,000, here only 500,000. But what you should look at is not actually these figures, but your return on investment. Correct? You get the most return on investment when you invested early and regularly. Is that clear? The third tip when it comes to investing in the stocks market is that you have to invest long term. Why is that? Long term investing solves the problem of short term volatility, or meaning to say the prices go up and down, just like in this case. Actually, for in stocks, it is really not um, assured, no, that it will go up or it will go down. It is like this, like a yo-yo. It keeps on going up and down. But although if it keeps up and down, but the trend, if you look at it over a long period of time, it's actually going up. All right. So that's why don't panic when the prices go down, just like in what is happening right now because of the pandemic. Okay. Anyway, so you can see from the chart below that the PSE index always bounces back to new heights even though there are problematic times. So instead of just, in withdrawing your money when times go bad, um, just, if you want, if the prices go down, don't buy. Okay, but then when it already hits rock bottom and then its prices again goes up, you can again buy. All right, so anyway, so this is like, see, you can see the upward trend over a long period of time. So this is actually from 1985 to 2010. That is actually long. That's over a 25-year period. All right. But for example, if you just look at, let's say, what is this, up to 2000 here. Okay, if you started in 1985, over 15-year period of time, prices still went up, right? If you started here and then you ended here. Is that clear? But for example, you started here. This is March 1999. And then you withdraw your money here. Lugi ka. So that is 10 years. That's 10 years already, right? Pero you will end up losing money. So again, when prices go down, don't panic. You can always think of it as when prices go down, it's like everything is on sale. So the better that you buy stocks. Okay. But again, there are tips in buying stocks. I will show you later on. There are a lot of ways where you can invest in the stock market. One of them is through Call Financial. So this is their website, callfinancial.com. And then you can actually see here, you can invest in stocks, invest in mutual funds. We will talk about mutual funds later. And then you can open an account online. And then there are also lots of program. So you can have investor education seminars, you have free 7-day trial, and then you have the easy investment program. So it's actually nice. Okay, so we're now inside the call financial just so that you can see what's inside. So the nice thing about here is that they have technical guide. So what does this mean? Okay, so if you do not, so they have, see, they are already saying they are now telling you the trend mode. Okay, so this one, for example, PBC, the trend mode is going up. So the recommendation is that you should take profits. Okay, so meaning to say, yeah, take your profits. And then they will also tell you if, oh, you should sell now. So as you can see, the percent from 52-week high, they're all down, right? They're all red. You see a um red here because remember what is the meaning of percent from 52-week high? Okay. So here, the highest in 1 year period, for example, this one, 8217. Now it's just 4039. So it decreased, right? So the percent decrease, is that 8? Where is that? Okay, but anyway, everything you have decrease, right? So that's why that is explained by all the red. And then this one, if something is already going up, it's telling you. So if it's going up again, it says just hold, don't buy, don't sell. Okay? What else? Here you can also see the announcement of dividend assessment. Diba? We already talked about dividend. So for example, let's click this or see. This company will have cash dividend. All right. What else? And then when you trade there, you go to trade. Oops. Okay, I will go back. I will come. Another way to invest through stocks market is through Investagram. Of course, you're familiar with this. But first, you have to analyze things. You just go to this one and then go to charts. Or if you want, go to investagrams.com/chart. So this is actually what I like about Investagrams. Call Financial does not have this graphical representation. So it will really give you good data so that you can decide whether you will want to buy or sell. All right. So you can look up the company that you want. So for example, this one, ABS-CBN. See? So as you can see, they hit bottom low and it's almost one share per stock. It doesn't have any value at all. So now here you can see the period that you want. So for example, you want to look at this is over 6 months. So as you can see here, this is what March 16, okay, up to this one, September 14. If you want to go, let's say 5 years, you want to see the trend. So as you can see, what is this? This is 2015. So actually, 2015 pa lang, the prices already started to fall. Or if you want to go to the 10-year period, where is that? Actually, okay, this is when the prices go up and that's the highest that it can be. That is called the, wait here. You can put, let's say here, label. I want to get, oops, move a little bit. I want to look at that there. So there, the price was 67.77 and wait, I want to put um balloon. Okay, for that one. Comment. So this is what you call the resistance, the highest price that it can be. All right. And then you can actually draw ruler, this one. This one, there. Okay, this point over here. Okay, that point over there, that is your support. When prices already started to, it declined and then it can no longer decline any further. So that is your balloon. This is your resistance or the lowest price for that particular period. Okay? So, for this period, what is this period? September 2010 up to this one, probably December 2016. This is resistance. So, actually, it's good. So, what you need to do is you buy when you hit resistance and then resistance. This is what you call support. I'm sorry. I cannot, there, I can still edit it. Support. All right. Okay, so basically the support is the lowest price, maybe lowest price over a certain period, over a oops, certain period. And then resistance also, I want to edit that. Highest price over a certain period. Okay? So the rule of thumb says, of course, this is the lowest price. So it's like everything is on sale, everything is on discount. So what should you do? You should buy here because when you buy here and the prices went up, that means you will gain money. Okay? All right. So, or for example, here, you hit here, and then you already see, prices already going down. So, if you want, kung nagsisimula pa lang siyang bumagsak, you can already sell because the point is, you still gain money. Okay, but of course, if you waited so long, the current price is already here, which is 13.40, you already lose money. Is that clear? Okay, let's look at one more example. Let's say SMPH. They're doing well this time. What are we looking at? So we're looking at from, what's this? 2010, of course, up to now. So this is over a 15-year period. So as you can see, again, prices are very volatile. But over time, right? It is going up. Although, of course, here, what is this? See? March 2020. This is when the ECQ. We already have, actually here pa lang, oh, bumagsak. March. Pagdating ng March. Okay, so maybe. So this is like the lowest point, right? This is your support. This is during the ECQ, right? You can also put a flag here. I will show you. There, oh, flag mark. So you have your ECQ there. Okay. Maybe I want to go to 6 months lang. Ayan. So, wait, I'll make it a little bigger. 1 year, oh, here. So this is March, the pandemic. And then May, it started to rise a little bit here. So see, here you have your resistance, right? And what is the price? 34.23. And then it started going down again. Okay. So that's it. That's how you use Instagrams to guide you whether you should buy or sell. Okay, by the way, there are also some things. So here, as you can see, there is an uptrend. You call this uptrend. Wait, from here to here. That is, oops. This is an uptrend. It's going up, but then this one naman, it's sort of this part here. You call that side, wait, this is trend line there. That is sideways. Okay, so this part here. What else? Of course, here, this is downtrend. Those are just some of the terms from here to here. So that's downtrend. So actually, I like Instagrams better because for Call Financial, it will just tell you, okay, you buy or you sell, but you don't really know what's happening. Unlike Instagrams, you can really see, although what you can do is you can look at Call Financial and then you look at the recommendation there and then verify the recommendation from Instagram so that you will not do it na okay just because they said that you have to buy, you will buy, or when you have to sell, you have to sell. Okay? But what I usually do is I always better pa rin if you can invest regularly so that the prices will be average. Again, it depends on what kind of investor are you. If you have the time to always look at the trend, that's okay. Pero if you do not like doing that, you can just invest regularly. Let's say every month. Okay. So that's it. All about in. All right. So let us now go to bonds. What are bonds? Bonds are actually loan made by an investor to a borrower. And that borrower is actually either a corporation, a company, or government. So to learn more about bonds, let's watch the following video.
Bonds are a common investment. However, to many investors, they remain a mystery. So let's explore what a bond is and how it might benefit your investment portfolio. A bond is simply a loan given to a company or government by an investor. By issuing a bond, a company or government borrows money from investors, who in return are paid interest on the money they've loaned. Companies and governments issue bonds frequently to fund new projects or ongoing expenses. Some investors use bonds in hopes of preserving the money they have while also generating additional income. Bonds are often viewed as a less risky alternative to stocks and are sometimes used to diversify a portfolio. Consider this example. The city of Fairview wants to build a new baseball stadium, so it decides to issue bonds to raise money. Each bond is a loan for $1,000, which Fairview promises to pay back in 10 years. To make this loan more attractive to investors, Fairview agrees to pay an annual interest rate of 5%, which in the bond world is also known as a coupon rate. An investor buys the bond at face value for $1,000. Now, let's fast forward. Each year, the city of Fairview pays the investor $50. These regular interest rates continue for the length of the bond, which is 10 years. Once the bond reaches maturity, The investor redeems his bond, and Fairview returns his $1,000 principal investment. This bond was a good deal for both the city and our investor. Fairview got the money it needed to build the stadium. The investor received regular interest payments and the return of the original investment. Because a bond offers regularly scheduled payments and the return of invested principal, bonds are often viewed as a more predictable and stable form of investing. Compare regular payments of a bond to the experience of owning a stock. With stocks, profits and losses are driven by market forces and are generally less predictable. Of course, like any investment, bonds are not without risk. One risk that bond investors face is the possibility that the issuer defaults on paying back the principal. This is what is known as default risk. Typically, bonds with higher default risk also come with higher coupon rates. The amount of risk depends mostly on the financial stability of the issuer. For example, most governments are generally considered stable issuers and issue bonds with a relatively low coupon rate. Corporate bonds typically represent a greater risk of default, as companies can and do go bankrupt. That's why corporate bonds often offer a higher coupon rate. Several credit rating agencies assign rankings to different bonds. This can help bond investors to gauge the financial strength of the bond issuer. These ratings agencies often use different criteria for measuring risk. So, it's a good idea to compare ratings when considering a particular bond. And keep in mind, rating agencies aren't always accurate. So be sure to research a bond and its risks thoroughly before investing. Another risk to consider is interest rate risk. This is the risk that interest rates will go up, and any bonds you own will be worth less if sold before the maturity date. After all, when interest rates rise, more investors allocate their money into the new, higher interest rate bonds. If you wanted to unload a low interest rate bond to take advantage of these new rates, you would have to sell your bond at a discount to make it a worthwhile purchase for another investor. Capital preservation and income generation are just two ways bonds might be part of a diversified portfolio. Many investors use a mix of stocks and bonds to pursue their investment goals. And because bonds move differently from stocks, they can help increase or protect portfolio returns. Keep in mind that this discussion showed you one simplified way that investors might use bonds, and only a few of the risks to consider. Like all investments, bonds are complex and have a variety of uses and risks. Before you invest in bonds, it's important that you invest in your own financial education.
Here are the terms that you need to know about bonds. First would be the par value. The par value is the amount of money a holder will get back once a bond matures. So, what does that mean? For example, I buy a bond and the par value is, wait, let's say the value is 50,000. This is the par value. So, par value with maturity on, let's say, August 2030. But I will only buy it for 30,000. This is the cost. Okay, so remember that the par value is different from the cost. Okay, although um, the bond may trade at a price either below or above the par value. So when you can, because for example, you do not want to wait until August 2030. You want to sell it already. Okay? So when you trade it, or meaning to say you sell it at a price higher than 50,000. Suppose you sold it at for the price of 54,000. We sell that the bond is selling at a premium. But when you sell it at a price lower than the par value, let's say you only sold it for 45,000, you are selling the bond at a discount. Understand? So remember, for premium or discount, it just depends whether the price that you sold it is higher or lower than the par value. Next is the coupon. So in the video, we learned that a bondholder will receive an amount, a regular amount as interest payment, and that is what you call your premium. Next, you have your maturity. Of course, the date in which the investor's principal will be paid. So in my example, my maturity is August 2030. And of course, the issuer is just the company issuing the bond. Okay? Okay. Suppose you bought a bond with a par value of 1,000, a coupon of 8%, and a maturity of 10 years. What does this mean? It means that you get an interest of 8% of 1,000, which is 80 pesos. But you get this 80 pesos for this is regular payment, right? Regular, this is regular payment for 10 years. So this 8% of 1,000, this is the just annual. Correct? So therefore, what is your interest talaga? That's 80 times 10. So that's 800. And at the end of 10 years, you will get your original, the par value, which is 1,000. Is that clear? So just like in stocks table, let's see, let's learn how to read a bond table. So of course, for this first column, it's giving you the company or government issuing the bond or the issuer. Then what is this coupon? That's the fixed interest rate that the issuer pays to the lender. So for example, in the previous slide, our coupon is 8%. Of course, you have your maturity date. This is the date when the borrower will pay the investor their principal back, the entire principal. And the bid price, this is the price someone is willing to pay for the bond. And take note that it is quoted in relation to 100, no matter what the par value is. What does this mean? So for example, if you will look at Coke, for example, Coke. Let's look at Coke. Oh, that's coupon. Oh, where there's no, I'm sorry. Let's look at the bid. Yeah, the bid. So for the bid, this is 99.59. So that means if I will buy a bond which has par value, let's say its par value is 10,000, okay? But the bid price is 99.59. That means that a person is willing to pay only 99.59% of 10,000. Is that clear? So meaning to say a person is willing to pay for the bond at a price of 9,959. So by at at 9,959 pesos. So meaning to say, if if a person is selling it at a price more than 9,959, then it's probable that no one will buy it. Okay? So meaning to say, you have to you have to set your bond price at a price lower than the bid. Okay? So that somebody will buy it. Okay, what is the yield? This column here is the yield. It gives the annual return until the bond matures. So how do we compute it? I is the bond's annual interest over the purchase price. Okay? What about the buyer's return? It is the profit obtained by a buyer of a bond. Take note that it's equal to, may I want to write it as F minus P plus IB. Now take note that IB is different from I. What is your I? This is the annual interest. This is actually IB is the total interest you get on bonds. Okay, so to illustrate, let's look at this example. So you have a 1 million face value, 5%, 5 years, and it is purchased from its original owner on par. Meaning to say the face value is the same as the purchase value. Let us compute for the yield. The yield is I, annual interest, over the purchase price. So the annual interest is 5% of 1 million over 1 million, correct? So this is 0.05 times 1 million over 1 million. So you still get 0.05. In percent form, that's 5%. What is the return on the buyer? F minus P plus IB. My F minus P is 0. But what is my total interest? Take note that 5% of 1 million is 50,000, but this is for 5 years. So I will get 50,000 every year. So times 5, that's 250,000. What if you purchase it for a price lower than the par value? So meaning to say at A, you it was sold at a discount. My yield is I over P. My I is still 50,000 or 5% of 1 million. And then my P, remember I is the annual interest. Okay, remember that. P is the purchase price. So that's 970,000. So when you do that, you will get approximately 5.15%. What is the return on the buyer? F minus P plus IB. My F or face value, 1 million minus 970,000. My IB is again, lagi naman, 50,000 times 5. So therefore, that is equal to 280,000. What if it was purchased at a price greater than its par value, or it is purchased at a premium? It means that what is my yield? 50,000 over 1.1 million. Correct? That is approximately equal to 4.54%. My return on the buyer, F minus P plus IB, face value 1 million, but the purchase price is 1.1 million plus 250,000. That is equal to 150,000. Okay? Let us talk about kinds of bonds. So the first one is government bonds. So in this case, the issuer will just be the government. So they will issue bonds so that they can um, generate money for their projects. Okay, and then next would be corporate bonds. Of course, similarly, it's just that the issuer are corporations. And lastly would be zero yield bonds. Let us talk about each kind of bonds in detail. So for the first one, government bonds. So again, I have already mentioned earlier that go governments use them to raise funds that can be spent on new projects. So in this case, you will be lending money to the government. So actually, this is a very secured bond because what's this? There's no It's like very. It's almost impossible for a government to go bankrupt or close, no? Unlike corporations. So just like in the case of ABS-CBN, you will think that they've been in the industry for a very long time, yet suddenly they shut down. Okay? Next. Okay, so let's look at this example. Suppose you invested 10,000 into a 10-year government bond with annual coupon. Again, this just means that you will be lending money to the government, and then you will get that 10,000 pesos from the government after 10 years. But in return, the government will give you 5% of your 10,000 every year. So meaning to say, what is 5% of 10,000? So 10,000, 1,100. So that is 500 every year for 10 years. The government will give you your 10,000 at the end of 10 years. But you will, it doesn't say here how much you bought what is the purchase price, okay? Well, let us now talk about the different kinds of government bonds. The first one would be treasury bills or T-bills. So these are actually the short-term bonds and they usually expire in less than 1 year. The second one would be the fixed rate treasury notes. They expire from 2 to 23 years and usually the interest are payable semi-annually. The last kind of government bonds would be retail treasury bonds. In this case, they expire from 2 to 24 years, but the interest is payable quarterly. So as you can see here, the fixed rate treasury notes and treasury bonds, they are both the same, what you call long-term investments. The only difference would be the payment of interests. Okay? As I have mentioned earlier, corporate bonds are bonds wherein you're lending money to companies. So these are debt issued by a company in order for it to raise capital. And an investor who buys a corporate bond is effectively lending money to the company in return again for this is very nice the series of interest payments. But then of course you can still trade your bonds on secondary market. Okay, let us talk about the risk in corporate bonds. So first, corporate bonds are somewhat riskier than government bonds because they have a tendency to go bankrupt, right? So that's the reason why um, they usually have higher interest rates to compensate for this additional risk. So again, the higher the risk, the higher would be the interest rate. There is a grading for corporate bonds. The highest yielding or the highest quality bonds, they are the safest, but of course lower yielding bonds. They are referred to as the triple A bonds, while the least credit worthy are termed junk. These are the well-known agencies that do the credit rating of bonds. So the Moody's, S&P, and Fitch. So these are their grading system. So S&P, this one, the triple A's, they are the high grade, and then AA minus. Okay, so if it's lower than double B plus, they are already considered as junk bonds. So for Fitch also, they are using triple A. For Moody's also, it's just that you just have a difference in the way they mark their bonds. Okay, so this is like a guide for investors whether they should invest in a specific corporate bond. And then what I have here is the list of bonds. So you can just go to this website, pds.com.ph, and then you will see the different kinds of bonds. So for example, here it's also giving you the coupon rate and then the issue date and then maturity date. Okay, so take note that bonds are not always available just like in stock markets because there there are just certain times now that they will issue bonds. Okay. All right, let's talk about zero coupon or zero yielding bonds. Okay, this is a kind of bond wherein it does not pay interest. Okay, just like with government bonds and corporate bonds, they give annual interest. But what they do is they trade at deep discounts, offering full face value or par value at maturity. And the difference between the purchase price and the par value will give the investors return. Alright, so for example, you have a zero coupon bond with face amount of 20,000 and a maturity of 20 years, but you will only buy it for 6,757. So what does this mean? There is no regular interest payment. So today you will buy it for 6,757 and then after 20 years, you get 20,000. So as you can see, there is no yield here because yield, to compute the yield, you will get annual interest, which you do not have. Okay? But what we can do is we can get the return on your investment. Correct? What would be the return on your investment? It's profit net na profit. But anyway, profit over cost. What is your profit here? It's 20,000 minus 6,757 over the cost. The cost is your purchase price, right? So when you do this, you will get approximately 195%, right? So, it's actually good, but the only difference here is what if the company goes bankrupt and then it's not able to pay you its loan? You did not get any annual payments, right? It's just like you just lost your money. Okay? All right, here. So, how do you purchase bonds? So, for example, so different banks actually also offer bonds. So, for example, here, Bank. Okay, the issuer is this one, Philippine government through the Bureau of Treasury. It's they're selling retail treasury bonds. So, issue and redemption price at par. So, meaning to say the face value. This is the gross rate. And then, of course, you still have 20% withholding tax. And here, you have your interest payments quarterly. Um, what else? And this is the minimum investment, minimum of 5,000 and in integral multiples of 5,000. So meaning to say, you can only invest either 5,000, 10,000, 15 multiples of 5,000. So this is a low risk investment because this is a government bond And you can say that it is a higher yielding instrument. All right, so suppose you invested 10,000 pesos in this bond. How much will you receive quarterly? So it says here that the gross rate is 2.625%. So you will get 10,000 times 0.02625. Is that correct? Yeah, right. But it says also here that it is still subject to 20% withholding tax. So meaning to say they will still deduct 20% of this. So they will still deduct 20%. So that means that you will only get 80% of this amount, correct? So that's why you multiply it by zero point 0.8. So how much is that? 0.02625 times zero point 0.8 times 10,000 is just 210 pesos. Correct. But interest payment is quarterly. So every quarter, they will just give you 210 divided by 4. So 52.5. Okay? Alright, so now that we have already talked about stocks and bonds, let's now look at their differences. So for stocks, the owners are, wait, let me just show everything first. The owners are partial owners, correct? You own part of the company, and of course, the price is very volatile. It goes up and down. It gives you higher return, but it also gives you higher risk. And the owners here have lower claim on assets, meaning to say if the company goes bankrupt, the company will first pay the people who invested in their bonds. Why is that? Because they owe money to these people. 'Di ba? Because since you're one of the owners, pag wala ng pera, di wala na. But you have to first settle your responsibilities to the people whom you owe money. Okay? That's why also investor gets a share on profits. Because again, the reason is you have to pay first to the person whom you owe money to. Okay? So as you can see here, bonds, the investors are creditors. They lend money to the companies or government as compared with stocks wherein they are partial owners. And the nice thing about bonds, that's why it's called secured, is they have fixed interest as compared with volatility in the interest in stocks. But of course, the downside of that is that they have lower return because they have lower risk as compared with stocks. And of course, they have higher claim on assets. And I'm sorry, but the investor do not share on profits. They will just get what the corporations or the government owe them, but they do not share on profit. So again, it has its downside and um, advantages. Okay, so again, it depends on what kind of investor are you. So there are many different websites that will determine what kind of investor are you, whether you are conservative or aggressive. Okay, because if you know the personality of in what kind of personality you have as an investor, it will actually help you what should you choose, stocks or bonds.